All right, so it's Singate LF, and today I'm gonna be giving y'all some juicy content for beginners. For beginners. So basically, I'm gonna be explaining the 30 terms that you need to know in day trading. Oh, if you don't know these terms, then I'm obviously not gonna. Nobody's gonna think that you're a real trader because these are the most basic terms that pretty sure everybody knows, and we're just gonna get straight into the video. So first things first, our first term is candlesticks. What is a candlestick? A candlestick is one of these things right here that's on the screen, and it shows the way that price move throughout the session. So on a normal chart, it would be green. For my chart is blue. Don't ask me why. But if it's green, that means that it went up. Price went up from the previous close. So for a green candle, the close would be the top, which would be, let me turn off the magnet feature, which would be right here. The wick that be above a bullish candle or any candle in general is the highest point that it got to. So that means in this session, on the 15-minute session, I'm at time frame. On the 15-minute time frame, this was the highest point that it got to, but then sellers brought it all the way back down to here, and this where it closed after the 15 minutes where it's over with. And this is the start of it because this is where it opened from the previous candle, and this was the lowest point that it got to. Okay, now let's do some more examples for a bullish candle before we go to the bearish candle. Right now, actually we can use it right now example. Boom, this is the highest point that is at right now and may keep on going higher. This is the lowest point. If it doesn't have a wick, that means it never went below or above that level. So right now it's leaving a wick because sellers is getting control back. So this is the highest point that it got to. This is where it's at right now. And this, well, not this actually, but we'd have to wait and see where the candle will close at. But I already marked out the two places that we have confirmed for right now. Let's use an example right here. This one. Let's go to a different one actually. Let's use this candle right here. One more bullish example. So boom, this is the highest point that the candle got to, the top of this wick, highest point that it got to in a 15-minute time frame. This is where it closed at, so that means price went all the way up here before closing right here at the end of the 15 minutes. This is where it opened at because this is where, bro, this is where it's closed at for the previous candle. So that means the next candle would obviously open right where the previous candle closed at. And this is the lowest point that this candle got to. Okay. Let's go to a bearish example. Now, bearish candlestick is showing that price went down since fourth. I don't know if that's actually a word, why it's called a bearish, and that's why it's red, because it could be bad for you if you're buying, it's good for you if you're selling slash shorting. So let's just get straight into it. So for a bearish candle, the open would be the top right here. For a bullish candle, the open would be right here, but for every bearish candle, the open would be at the top. And same thing, this is the highest point that it got to. This is the lowest point that it got to. And this is where the candle closed at for a bearish example. Price went all the way up here, but the buyers brought it back down to here. This was the lowest point that it got to. But did I say that wrong? This is the highest point that it got to, but the sellers brought it all the way back down here. This was the lowest point that it got to, but the buyers, aka basically the bullish wicks people, if you want to call it that, brought it all the way back up to here. And this is where it closed at on the 15-minute time frame. This is the open. This is the highest point that it got to. This is the lowest point that it got to. And this is where it closed at in the 15-minute time frame. Let's go to a different time frame for some more examples. Let's go to the 5-minute. Nothing really changes. Boom. Let's use a candle with no wick this time, right? This is the lowest point that it got to. This would be the highest point and where it opened at. Since there's no wick, this is the highest point that it got to. And this is also where it opened at. And this is where it closed at on the 5-minute time frame. Let me see if I can find a candle with no wick at all on neither side. I'll go to the 1 minute for that. Here's one right here. So boom, if it has no wicks at all, This is where it opened at. That's the highest point that it got to. This is where it closed at. That's the lowest point it got to. Vice versa for a bullish candle. For a bullish candle, this is the highest point. I mean, this is the lowest point that it got to, and this is also where it opened at. This is the highest point that it got to, and that's also where it closed at. Simple as that. All right, so now we're going to be looking at support. What is support? Now, support is basically a level in price where price would more than likely bounce back up from this level. So we're just going to use this as an example. Let's say support would be right here, which actually could be used as a point of support. Price could go up, go down, go up. Once it gets back over here, it bounces from off of it. We know that this is support again. So if price starts going back down to it, we can know that is more than likely has a chance to bounce back, respond from off of it once more. And that's basically all support is. Support will always be on the bottom of that. Always be on the bottom. Let's use this as a quick example. Boom. Price starts right here, taps into it, goes back up, taps into it, goes back up a little bit, and then it finally break through it. So support is not invincible, and there's a chance that it will just break through it. We have another example right here on the 30-minute. Support price. Boom. This is the starts. Taps into it, bounce from off of it. Taps into it, bounce from off of it. Finally gets a break above it. I mean below it. Simple as that. Support. Let's find some more examples. Boom. Another example right here. Support. Let's go to the smaller time frame so we can get a better view of this. You know what I mean? What the fuck? All right, so boom. Support price taps into it, goes up, taps into it, goes up. Boom. Price moves, taps into it, goes up, taps into it, goes up. Boom. All that good stuff. Watch that. Taps back into it again. Boom. Goes up, taps back into it, goes up a little bit before finally breaking below it. That is support in a nutshell. Well, not in a nutshell. That's literally support. Now let's talk about resistance. That's our third topic for this video, resistance. So resistance is basically the opposite of support. Resistance will always be on top, and it's a zone where, well, can I speak correctly? It is a point in price, or it's an area in price where price would likely reject from off of. So let's use this as an example real quick. Let's say price is moving, boom, rejects from off of it, taps back into it, boom, rejects from off of it. That's resistance. Now let me go on the chart and see if I can find an example. I should be able to find an example. Let's use this as an example. Is this a good example? Yeah, we can use this. Boom. So let's see. Price is moving. Boom. Taps into it, goes down. Boom. Taps into it, go down. Boom. Taps into it, goes down. We can go back over here. Watch this. Watch this. Price taps into it, boom, goes down, taps into it, boom, goes down, taps into it, down, taps in, down, boom, finally gets a break. You have so many short opportunities right there. Holy shit. Got some more right here. Actually, let me get a good example of this one. Boom. Price starts it, taps into it, goes down, taps into it, goes down barely, taps into it, goes down, taps into it, goes down, doesn't go all the way down into it, starts consolidating it in a little bit, goes down, taps back into it, consolidates back into it, breaks above it, but still goes down, tap into it, go down, boom, finally gets the breaks. So many short opportunities right there. And if you really want to count it, have another one right here. Boom. Basically the same thing, but it started it off right here. Man, from right here, started off. Boom, reject him off of it. Simple as that. That is support and resistance. Now it's time for the fourth turn. All right, so now we're going to be looking at pullback. So pullbacks are basically when we're in a trend. Let's use an uptrend example. Go a little bit up off the charts. A pullback would be, we're in an uptrend. That would be the pullback into the longer leg, pullback, longer leg, pullback, longer leg. That's all the pullback is. For a bearish example, you have pullback into the longer leg, pullback to the longer leg, pullback into the longer leg. That's all a pullback is in the markets. So now let's go on the charts for us to see pullbacks happening in real time. So boom, down, pullback, down, pullback, down, pullback, down, pullback, down, pullback. Most likely gonna go lower. This example. Let's go to the bullish example. Do I have any like explicit? Wish I could use this. Actually, it just keeps on going up for this little pullback right here. Up, pullback, up. Then that's basically the end of the channel, really, because then it just, or I guess you could say it continues like right here, but it didn't take out this high. But now this kind of starts a downtrend. Starts. I said sharp. Starts a downtrend. Up, down, up, pullback, consolidation. And then easiest way to see a pullback, in my opinion, you just go on the line chart though, and it just shows you. So, for example, right here, up, pullback, up, pullback, basically consolidation, all right here, down, up, pullback, boom, boom, consolidation, finally goes back up, pullback, consolidate. Holy, this started a downtrend, yeah. So up, pullback, up. This is where it starts. Down, little pullback up, down, little pullback up, goes up again. I think you get the gist of it. Now, let's talk about all-time highs. What are all-time highs in the market? An all-time high is basically the highest point of the market. If you can't understand this, I don't think you need to be. So, right here for Solana, this would be the all-time high. This is the highest point that it ever got in the market. Bitcoin, all-time high is right there. Highest point that it got into the market. The US dollar index fund, highest point that it got to. XRP, wasn't it $3? Yeah, highest point that it got to. If we go to the S&P, actually making all-time highs right now, which is kind of crazy. But this would be the all-time highs right now for S&P. S&P 500 index. And yeah, let's talk about the daily. The previous day close. What am I saying? The previous day close. All right, previous day close would basically just be a bearish candle right here. Wait, no, that was on the weekly when I did that. Previous day close would be the previous day close. It's like the previous candle that is not on the candle that we're on now, where it closed at. So for a bearish example, like I said, for the candlesticks, the bottom of a bearish candle is where it closed at. As you can see, use that. Oh my God, that's juicy. Oh, you didn't hear that. That's the previous day close for Solana. Previous day close for Bitcoin here. We're retracing back too. We kind of been on this level like all day. XRP. Let's go to the US index fund. Not index fund, index futures. For a bullish example, previous day close would be about right there. For a bullish example, price tapped into it, went down. Simple as that. All right, now we're finally to trade. What the fuck? Now you're finally at the risk and performance part of this video. We have one more section, I'm pretty sure. We're going to be talking about risk and reward ratio, your win rate, your position size, and drawdown. What all of these means, where can you find it at, how to describe it. Let's just get straight into it. Your risk to reward ratio. This is what separates the profitable traders from the unprofitable traders. The easiest way for you to see your risk to reward ratio would be, if you're going long, put it on a chart. Say you're risking like this much, and boom, your risk to reward will be 4.62. Let's go into a better example. Your risk is how much money you would be risking. So let's say you're risking just $500. So put your stop loss to, bro, 500. Why the fuck is it not at 500? And then you have your TP at whichever level, which would be right here. So you would be risking $483 to make 1,380, which would be a 4.62 risk to reward, because 400 times 4.62 would equal to, you know what I mean now. Boom. That's risk to reward. Your win rate, how much you win. This is basically win to losses. how much you win and how much you lose, and that's self-explanatory. I don't know how you don't know what win rate is, but it's basically all it is. Your position size. Your position size is basically the units or margin, leverage, all that good stuff. So for Solana, let's say you're on a 50K funded account with 5x leverage, right? You could do 1,880 units, which would equal to 100 and basically $130,000 with leverage on it, obviously. But I mean, that's basically position size. I don't know what else. I'm not too geeky at it. I'm not gonna lie, but that's really all you need to know. There's some other stuff like lot sizes, which I'm pretty sure is position size as well. But that's basically it. Now your drawdown. Let's use this as an example. You have $100,000 in an account. Actually, $10,000 into an account, right? That's what you start with. By 6 months, as you've been trading for 6 months on that 10K account, and you're now at $5,000. So that means you have a $5,000 drawdown, aka a 50% drawdown from what you initially started at. That's all that drawdown is, how much you're down. All right, you're getting it now. You know what I mean? Dude, you finally made it into the trade mechanics part of this video. And now I'm doing it a little different. You actually see what I'm going to be talking about next. So let's just get straight into it. So this could be a short video, as short as possible. Hopefully, I don't know what all the clips together is, but honestly, I don't give a fuck either. So start. Let's talk about entry. An entry is where you're going to enter in the market. So let's say, boom, we have some type of, oh shoot, liquidity got swept or something. Boom, that's our entry. So right when that happens, whatever it is, boom, take your entry. You're buying now. He got swept. Simple as that. Exit. Exit is exiting the trade. So you just press the button, the close button, close position. I don't know why short isn't here. A long and buy is the same thing. A long is when price goes up, you make money. Simple as that. So if price going up, for my you make money. That's a long. If it keeps on going down, I lose money. Now, if you want to make money while price is going down, you enter short, which is not up here, but we're going to talk about it anyways. Boom. Short slash sell. Price is going to go down short, and then boom, you make money when price goes down. Now, as you can see, this price going to do? Will price do something? Price goes down. My money went up. Simple as that. Now let's talk about float. Float or floating is your floating profit. So you see right now, I'm up $161. I haven't closed it. I haven't did anything with it. I haven't took partials or anything. So this is just floating profit. I could make more money or I could lose more money. So that's why it's not good to flex your floating profit, because you can flex it. It shows that you got 2K. You still haven't closed the trade. It can end up in the negatives. You losing money. That's floating profit. Volume is, holy shit. Volume is basically how much price moves, like the speed, the way that price moves. So as you can see right here, this would be high volume right here. Literally like 120 pips in like 30 minutes. That's high volume right there. Another high volume move right here. Boom. That's basically all that volume is. Simply. Let's close this trade. That's how you exit the market. Another example. Holy shit. Now we're going to be talking about order types in the markets. We're going to be talking about market orders and limit orders, showing what they do, how they do it, what it does, explaining. Let's get straight into it. First, we're going to start with market orders. So market orders, which would be right here. Holy shit. Market orders is to buy or sell at the current price or the closest price that is current to this price. So for an example, for an example, if we do If we're buying, we're gonna buy exactly where price is at on paper trading, right? As you can see, market order executed. If you're on a funded account or like a live account, it won't exactly be where you would do it at. So I know on prop firms, if you buy, for an example, if you buy like right here, you're really gonna execute maybe like right here, right here. And if you sell right here, it's really gonna execute like right here. So price would have to, you would be in the negatives basically, and price will have to get to that level before you even start making profits, which is the shitty thing about it. But let's set a TP, honestly. Let's check out this high. And now limit orders. Limit orders are basically where you have a level, and once price reaches that level, that's when your order will be executed. So let's say price goes consolidating, you have a limit right here. Boom, price goes down. That's when you will finally get into the market and you'll start making or losing money, whatever the case may be, whatever you do. So yeah. All right, now we're gonna be talking about fair value gaps and breakouts. So a fair value gap is something that when price moves, it leaves a little gap in the market, and that gap could be used for you to enter and make trades basically. So let me just show you a quick example of a fair value gap. Let's go on the higher time frame. Also, it could be used on a lower time frame as well, but here's one right here. Here's a bearish example. A lot of people be saying that it has to be all red. Me personally, I don't really care if it's all three of them red. Let me show you an example first off before I goes into showing you on the chart. A fair value gap is the bottom of the first candle going into like the shadow of the second candle and the top of the third candle. This is a fair value gap right here. And as you can see, it worked. Price tried to go above it, it rejected from off of it and kept on going lower. Boom. That is a fair value gap. A bearish example. Now the bullish example of a fair value gap, which would be right here. All right, that shit did not work. It got inverse. Let me find a quick bullish example. Holy shit. Let me go on a smaller time frame at this point. Boom, bullish example. We have the top of the first wick and the bottom of the third wick overlapping this second middle wick, whatever you want to call it. Price taps into it, hits the 50% level. Oh my God, that's juicy. Price goes high. Simple as that. Now, people say that it has to be all blue for a bullish fair value gap or all red for a bearish, but honestly, it's usable if it leaves a gap, but it works more, I guess, when it's three bearish. I don't really know. Hey, that's a fair value gap. And let me show you the inverse fair value gap as well. Basically, an inverse fair value gap is hold on real quick. It's basically when the fair value gaps get disrespected. Let me show you a bullish example or basically a bearish example. So price responded from off of it the first time, goes up, finally breaks down below it. Short entry right there. Oh shit. What the hell? Oh shit. What the hell? Boom. You got an entry. Target points of liquidity. 2 risk reward just off that. Let me show you another example of the inverse fair value gap. Here's an example right here. Boom. This is the fair value gap. It gets inverse. Price broke above it. As you can see on this candle right here. What the hell? On this candle right here. Go for my long. Stop loss a few pips below the fair value gap. Liquidity. 2 risk reward. Simple as that. That's inverse fair value gaps. Now let me show you the breakout. Now breakout is honestly something I don't use, but I did used to use it back when I was first starting. I don't like to use it because I feel like it's honestly bullshit, but people's profitable with it. So I'm gonna show it to you. So a breakout is basically could be the top of a wick like this and the bottom of a wick like this, price breaks below it, you can get a short. What are we targeting? All right, I'm not gonna scroll back just to find something for something like this, but it's money. Let me use another example. All right, so now let's talk about take profit and a stop loss. So take profit is once you execute your order, take profit is where price will stop at, and wherever that you have your take profit at, that's where price will close at. So let's say it's like 9 o'clock, you go to sleep at 10, you have an order, but you won't be awake to like close that order manually if you're in profit or you're down money. So you set a stop loss. So when price reaches that level, that's where it will just take off the money and you'll be cool. Now let's use a stop loss example because I'm actually getting fucked right now, right? So boom, a stop loss is basically the opposite of a take profit. Once it reaches that zone, price will stop it right there and you won't lose any more money. Okay, you got it now. You're learning. Now the last thing for this video, PNL. What does PNL mean? PNL stands for profit and loss. The P is profit, the and is and the L is loss. So this could be all time, or this could be for the day. How much money you made and how much money you lost all together in total. So let's say you make $1,000. Let's say you make $1,000 today, but you lose five. You make $1,000 on the first trade and you lose $500 on the second trade. So that means your P&L would be $500 because that's everything together for the day. All time, that's your all times wins and losses. That's basically it. And I mean, not your all time wins and losses, your all time profit and losses. Let's say first 6 months you made, I don't know, fucking 10,000. The next 6 months you lose like 2,000. Boom. All right, so your P&L would be 3,000 all the time. Simple as that. Those are simple trades that everybody, can I speak correctly? Those are simple terms in the day trading market, financial markets in general, that almost everybody knows, whoever day trades. Thank you for watching if anybody watches this video. And yeah, skadooshers.